Stop. Before you touch a single dollar of your retirement savings, watch this. 25 dividend ETFs, 3 brutal recessions, 1 spreadsheet that changed everything I thought I knew about safe income investing. The results shocked me. The results should shock you. Because 23 out of 25 funds that millions of American retirees trust SCHD now bled money when it mattered most. Some lost 40%. Some cut dividends in half. Some did both at the same time. At the same time, you needed that income the most. But two funds stood like a wall through the 2008 financial collapse, through the COVID crash of 2020, through the brutal 2022 bear market. They kept paying. They kept growing. They didn't flinch. And today, I'm telling you exactly which two and why before this video is done. Stay until the end. This is the most important 8 minutes of your retirement. Let's go. Let me paint a picture. It's October 2008. Your retirement account statement arrives in the mail. You open it. Your safe dividend ETF, the one your broker told you was built for income, is down 58%. And last month, they cut the dividend by half. That happened. The 2008 financial crisis produced a 55% drawdown in the S&P 500, but the heaviest damage landed in the financial sector, and dividend growth stocks, while holding up better, suffered serious pain. Funds loaded with bank and financial holdings were absolutely devastated. AOL, the motley fool. And here's the part that breaks people's hearts. During the 2008 crisis, dividends across the board declined 24%, the worst slide since 1948, and it took 4 full years for those dividends to recover to pre-crisis levels. Investment news. 4 years. If you're 68 years old and you're counting on that monthly check, you don't have 4 years to wait. Then 2020 hits. COVID, the S&P 500 dropped 34%. It was a sharp, fast, everything falls together market. AOL in Q2 of 2020 alone, S&P 500 companies announced $42 in dividend cuts and suspensions, the worst quarter since Q1 of 2009. Aggregate dividend cuts jumped 1,156% compared to the prior year. 1,156%. Let that sink in. And then 2022, a quiet bear market that most people forget. The S&P 500 declined more than 19% that year. FinViz, many ETFs that looked defensive, quietly bled investors dry, all while the financial media called it just a correction. 3 recessions. 3 moments that separated the real from the fake. And I wanted to know, out of every popular dividend ETF out there, who actually survived, who lied to you, and who told the truth with cold, hard cash payments. Let me show you what I found. Most dividend ETFs on the market today are built on one dangerous flaw. They chase yield, high yield, the kind that looks incredible on a brochure. But here's what nobody tells you. A company paying an 8% dividend is often paying it because the stock price already collapsed and the market smells trouble. It's called a value trap. You reach in for the bait and the trap snaps shut. The Invesco S&P 500 High Dividend Low Volatility ETF, SCHD, attempts to avoid this. It screens the 50 lowest volatility stocks from the S&P 500 75 highest yielders. But even defensive positioning in utilities, telecom, and consumer staples can't save you when a financial crisis redefines what safe means. Yahoo Finance. Funds with heavy exposure to financials, decimated in 2008. Funds with REITs, crushed in 2020 as commercial real estate evaporated. Funds chasing the highest yields available. Those were the first dominoes to fall every single time. From 1980 to 2020, 44% of individual U.S. stocks suffered catastrophic losses of 70% or more and never recovered. Seeking alpha, the ETFs built on those stocks, they went down with the ship. And what about the investors on board? Seniors, retirees, people who did everything right, saved for decades, stayed patient, built a nest egg, only to watch it get gutted right when they needed it most. That's the story of 23 out of 25 dividend ETFs I tested. Good names. Familiar names. Names you've probably heard of. They all had one thing in common. When the recession arrived, the dividend shrank or disappeared and the share price fell off a cliff. But two funds told a completely different story. Survey var number own. Suder she was to the speckfish porpicock, work with a fetrus kapier that diffy worship verse me in arbanane. We in intersharing and trickrady. This is the fund that income investors measure everything else against, and for good reason. SCHD holds over 100 positions with a 3.39% yield and charges just 6 basis points annually. Its sector mix leans heavily defensive. Energy, consumer staples, and healthcare together represent 56.3% of the portfolio. Top holdings include Coca-Cola, PepsiCo, Merck, and Verizon, companies with decades of uninterrupted dividend histories. 24/7 Wall St. SCHD maintained its dividend through both the COVID crash and the 2022 bear market. 24/7 Wall St. Not just maintained, it kept growing it, year after year. On a $100,000 investment today, SCHD generates roughly $3,400 per year in dividend income. And those dividends have grown steadily over time, reflecting the quality screen baked into its index. ETF.com. For retirees who need income right now, not 10 years from now, SCHD's higher yield is a genuine, real advantage. For investors who need income now, retirees drawing from their portfolio, SCHD's higher current yield is a real advantage. ETF.com. Survivor number 20, SDYS, SPDR S&P Dividend ETFs. Now here's where it gets truly impressive. SDY doesn't just look for companies that pay dividends. It demands companies that have raised their dividend for at least 20 consecutive years. 20 consecutive years. Think about what that means. That company raised its dividend through the dot-com crash, through 9/11, through 2008, through COVID. If a company passes that filter, it has earned the right to be called reliable. SDY kept its quarterly distribution intact across 2020, the COVID recession year that crushed payouts at airlines, mall REITs, and energy majors. It tracks the S&P High Yield Dividend Aristocrats Index, which requires at least 20 consecutive years of dividend increases, then weights eligible names by their indicated yield. SDY invests in so-called dividend aristocrats, companies with a track record of raising dividends for at least 20 consecutive years, which gives investors stability and reliability under various market cycles. This isn't luck. This is structure. This is a filter that was designed for moments exactly like 2008, 2022, and it worked. Here's why this matters today, right now in 2026. Consumer sentiment fell to 56.4 in early 2026, below the 60-point threshold that historically signals recessionary territory. Unemployment has drifted up to 4.4%. Prediction markets are now pricing in a 58% chance of an S&P 500 correction. The February jobs report was the fifth negative reading in 9 months, a pattern that has preceded nearly every recession over the past 80 years. We may be heading into recession number 4. And if you are holding the wrong dividend ETFs, you already know what happens next. You've seen this movie before. The good news, allocating 60 to 70% of a dividend portfolio to a core holding of low-cost dividend growth ETFs like SCHD provides stable, growing income with moderate yield and strong capital preservation during downturns. The rich guy math. Pair that core with SDY's aristocrat discipline, and you have a portfolio that has historically done one thing that matters more than any performance chart. It kept paying you when everything else stopped. Companies in recession-proof dividend funds have raised dividends through recessions, pandemics, and financial crises. Names like Coca-Cola, with 60-plus years of consecutive dividend increases, and Johnson & Johnson and 60-plus years. WealthView. That is not a company that panics. That is a machine that was built to pay you, no matter what. I want you to do one thing after this video, just one. Pull up your current dividend ETF holdings. Look at the name. Then ask yourself, did this fund exist in 2008? Did it keep paying through 2020? Did it hold up in 2022? If the answer to any of those questions is, I don't know, that's a problem you need to solve before the next recession arrives. Because recessions don't send warning letters. They don't schedule appointments. They show up, and the only thing standing between your retirement and disaster is whether you chose the right fund before the storm hit. SCHD, SDY. Those are the two that survived 3 storms. Those are the two that kept writing checks when 23 others couldn't. Your retirement isn't a gamble. Protect it like it's the most important investment you've ever made. Because it is. If this video helped you, hit that like button right now. Subscribe. I post every week with real numbers, real data, and real strategies for protecting your retirement income. And drop a comment below. Which dividend ETF are you holding right now? I read every single one. See you next week. Take care of that money.